afternoon, ladies and gentlemen. Welcome back to Business Today Television's special show, Market Guru, where you get to meet the finest brains that there are on Dalal Street, individuals and professionals who've made serious long-term wealth for their customers, for their unit holders, and for themselves as well. They have navigated bull markets, bear markets, investment cycles, capex plans, and so many other events that keep on happening unpredictably on Dalal Street, that they are masters of their game. Today we are fortunate to speak to Mr. Aditya Sood. He is the fund manager of InCred Asset Management and a gentleman with a very strong grip on market earnings, on business cycles, as all to where to invest and what not to do. Namaste Aditya ji, and a very warm welcome. I wish the opportunity on Dalal Street was as big as it is now, a little earlier. For fund managers and value buyers such as you, this is the right time. How do you describe sentiment on Dalal Street today? Is this a point of concern, or is this just the right time to buy quality?
I think so. At the outset, we have witnessed, various corrections in the bull market. Obviously, this correction has been very, very fast and furious. There is no denying that fact. But it has interestingly coincided in a very, very interesting backdrop. On one hand, you have got, the tariff-related question marks that, everybody is trying to, grapple with. On the second hand, we have seen a massive slowdown in terms of earnings. And this creates a very, very interesting opportunity because at least there are 3,000 odd stocks, and that number, as you can imagine, keeps on changing with every evolving week. So 3,000 stocks have corrected close to 50 to 40%. And our take always has been that in bull markets, corrections are very, very sharp and swift. Anybody who has, lived through bull markets, for example, in 2007 in May, we had a very sharp correction in small and mid-cap stocks. So bull markets always climb a wall of worry. So it doesn't, surprise us in any way. So one needs to be very, very focused. And the good part of the ongoing correction is that, you can find a lot of value in a lot of stocks wherein the risk to reward is really very, very favorable. So the way we look at, companies internally at InCred is that we would look at a bear case fair value of a stock. And, today what we are witnessing is that, a lot of stocks are closer to the bottom or very, very close to that bear case fair value. And obviously one has to keep, the optionality in mind. So we believe that this is a very, very constructive sort of a market environment. And the second element is that, every 5 years or 4 to 5 years, we get this kind of correction in the market. So this is a very good time to deploy capital.
Right. Before we go ahead, Aditya, there is a 24% correction on the small cap index, almost a 20% correction on the mid cap index, respectively, from their all-time highs. Are we in classic bear market territory as far as this very, very popular and very widely owned space is concerned, mids and smalls?
Sure. So first of all, I would just like to make a slight differentiation here. If you exclude top 100 companies in India, everything in India is mid and small, going by the regulatory definition. So what we believe is that, coloring mid and small caps with the same brush might not be true. This shouldn't be done. The second point here is that when you look at this mid and small cap as a space, it comprises of value stock, it comprises of growth stock, it comprises of some popular themes which were very, very popular. For example, renewables, solar was a very, very popular theme in this bull market. We also saw, public sector enterprises being a very, very popular theme in this bull market. So our view is that, obviously in the next bull market, there are going to be certain sectors which are going to lead the way, not necessarily the sectors which have already done well. Because typically what happens in every bull market is that, there is an element of PE expansion that happens in new age sectors. And this is what we saw in EMS or renewables. And that typically happens because investors don't really have too many choices to deploy capital. And people think that, the first EMS company needs to be bought into. And subsequently, what we have seen is that, as the product basket keeps on getting wider, you get more opportunities to deploy capital. So our view is that
Okay.
the next bull market would have new set of emerging winners.
Okay. Aditya, let's get down to brass tacks. We have your portfolio for emerging business fund. This is a category 3 alternate investment fund, and it's sort of outperformed the BSC 500 by following less in a falling market and rising more when the markets are up. So this is a wonderful performance, and you will just see graphics coming in. In terms of top 10 holdings, the fund has Newland Laboratories, Indraprasth Medical Corporation, Stovecraft Limited, R Systems International, and Healthcare Global Enterprises. Aditya, as per and of course this is a long term portfolio we've discussed earlier as well. Very little change that has happened. One, this is a domestic focused fund with very little to do with the problems emanating from the US, disruptions in global supply chain, a weakening rupee and all. You seem to have very well shielded your purchases by going for stocks that have little to do with global linkages. Was that a well thought out plan, or it just happened by the way?
It was clearly very well thought out, and I'll just give you, the unique perspective that we are witnessing. Why this global turmoil that we are seeing in the global bond markets is a very very unique perspective for a lot of investors who are managing money, and a lot of fund managers as well. So the first point here is that in my long investing career, which has lasted over last 20 years, I have never seen Japanese interest rates being lower than China. That happens to be the case as I speak to you today. I have never seen a 300 basis point interest rate differential between China and US, which is 1.5% yield 10-year in China and 4.5 thereabouts in US, right? Uh, if you look at the eurozone, euro dollar is almost at parity. It used to be 1.6 7 8 years back. It is at parity today, right? If you look at the US economy, the data that is being showcased, if I look at the credit card defaults in the US, if I look at the mortgage interest rate differential between US and India, you can possibly get a new mortgage in US at 8%. Possibly in India, you can get it at 8 to 9%. It is the lowest ever that we have witnessed. Now, all this was pointing out to very new circumstances as far as global macros. So I am not highlighting what is going to turn out to be negative or positive from the tariffs, obviously, because that continues to be the question mark. Hence, the conscious decision that we took was that we need to be focused on sectors which have tailwind on a bottom-up basis. So, out of these four names that you talked about, uh, three of these companies are either hospitals or one of this company is a CDMO player, which happens to be Newland. So, in our view, one had to be in sectors wherein earnings recovery will happen because they have strong sectoral tailwinds. But more importantly, when the broader market earnings are not getting delivered, these companies should stand out, because I don't think so. Each of these companies would have they don't have a discretionary element of spending, right? Indraprasth Medical or possibly HCG would have great bargaining power with their customers, essentially. So they are not discretionary. So that is what our thought process was. That we want to outperform in a falling to a flattish market, and that is what matters the most in fund management, to my experience. Because in a rising market, any which ways it becomes market delivers or it surprises you on its way up, essentially. So our view is that in a rising market, it is easier for people to outperform. But how a product stands out in a flattish to a declining market, that is what matters the most. So that is how we have constructed the mandate at InCred.
Yes, that these stocks are down anywhere between 15 to 20% from their peak, especially new land, especially I am Indraprasth Medical, as also Stovecraft. Are these opportunities to maybe add to your existing portfolio? Are you asking your clients to supply you with fresh capital, Aditya?
Yeah, so I can say this with a lot of confidence today that we see a lot of these companies bottoming out, even in cases wherein we have seen a very very sharp element of correction happening. One of the stocks that we have introduced in the portfolio is a company known as Tejas Networks, right? Which was not there as a part of the emerging business fund portfolio, since inception. But we wanted to, strengthen our focus on companies wherein earnings delivery is not going to be challenging. So for example, if you look at the sharp fall in Tejas Network, from the peak, what we find here very very interesting and intriguing is that obviously it is a well known fact that it is a company which is owned by the Tata Group. The narrative when they acquired this company was more centered
Yes.
around BharatNet as a project. Now the interesting bit is that even after 4 years, past 4 years when they acquired this company, the BharatNet orders have not come through. There is only a narrative of BharatNet. And we
Yes.
believe that this opportunity is going to be, 8 to 10,000 crore opportunity for them. They have another new opportunity, which is the uh, anti-collision railway kavach program, which Tejas has highlighted, time and again. I think so that this is a very, very big opportunity for them. It could be a 1,500 to a 2,000 crore opportunity. And then the wireless implementation of 4G, 5G. In fact, it was just reported over the weekend that BSNL has turned profitable second time after 2007, essentially. So Tejas has successfully implemented the wireless solution here for BSNL. So our view is that this is a very very high capability company, and if you look at what the Tatas have been in a position to do by taking control of the management is to add more patents, more R&D. So our view is that all these companies are going to emerge much much stronger. So what we are doing it is a twofold approach. One is that we are introducing stocks in the portfolio with great earnings visibility if we find an opportunity. The second thing that we are doing is that we are reinforcing our conviction and buying more of the stocks, or we call it sizing, essentially, that you buy more in companies wherein you understand these companies well. And the third obvious thing is that going back to our clients and telling them that possibly this is the right kind of market wherein you should be allocating more to your portfolios.
Fair point. Aditya, one thing I wanted to check with you, given the correction that has happened and the fact that I am sure you have a huge catchment of stocks which you track, at this point of time, are you going to deploy fresh capital into new purchases, or are you going to add or average the existing ones?
I think so. It is little bit of both, to be very frank and honest. We believe that the next up cycle is going to have new set of winners, right? There could be companies wherein we wanted to position ourselves well, and we couldn't because, sorry.
Please
Uh,
continue, sir.
let's say in areas like renewables, right? We were watching that space very very closely, but we couldn't find a way to position ourselves. So the route that we are taking is that we won't, we don't like to sort of expose our clients to a similar sort of, you know, risk profile, given uh, that, the stocks have fallen. But what we want to do is that we want to invest into second derivatives in certain areas, wherein, the next round of uptick. And what we have seen is that, in most of the falls, cash flow is the key when you are buying companies. So today, one of the parameters that we have used in terms of our stock picking ability is to look at operating cash flows very, very carefully, especially when earnings decline. So today we can find, companies which are trading at, let's say, the lower end of the PE band or the price is to operating cash flow band over a 5 to 10 years, right? Definitely, you can find companies. You can find two set of companies. One set of companies possibly are great businesses and they have not made money for 5 years for investors, right? Clearly, you have got, companies like HDFC Bank or Kotak Bank falling into that category, or for example, a Bajaj Finserv, which has not done well. We own that company and last 4 years have been, sort of zero return or no return, right? So that is category A. Category B could be companies wherein we believe that P multiple can expand over a period of time because, when the sector was, sort of overowned, uh, these PE multiples had limited scope of expansion. So we would like to bet on companies wherein both earnings growth can go up and PE multiple can also expand over a period of time. And that makes a very good combination, for the next leg of upcoming growth. If you can buy resilient companies and PE multiple can also expand and earnings growth is going to be in that 90 to 20% sort of a range. So if you look at our portfolio construction at a portfolio level, our return on invested capital, which is a proxy of high quality of businesses that we own, X of financials is 30%. Earnings growth is in the vicinity of 19 to 20% for next 2 years. And the good news is that most of at a portfolio aggregate level, the P of the portfolio is going to be slightly higher than the market P. For example, if the Nifty P today is, closer to 19 times 1 year forward, the portfolio would be at a 20 to 23 times, sort of P multiple profile. Now, if we can strike a balance between buying high quality companies, not overpaying for growth, and buying, obviously higher than market growth rate, that is a very, very good combination to, bet on.
Okay, fine. So, apart from renewables, which you say you are hunting in, what would be the space? Are you looking at NBFCs that fund renewables? Are you looking at solar powered companies? Are you looking at those who trade power in the renewable space? It's a very wide catchment of stocks when it comes to renewables. What catches your fancy? Solar, wind, coal, you know, there could be 50 companies. What are you looking at?
Sure. So we are looking at essentially the ancillary service providers in the renewable space. It could be a crane rental company, for example, which has just declined by, 50%. Not necessarily a direct renewable play. See, one of the things that we have seen is that, in sectors which are cyclical, essentially, it is better to bet on something, a market leader, which is not so cyclical. And I can give you a very simple example. 5 years back, we took a call that, we want to invest into a company known as Linde India, right? So if you are bullish on the manufacturing story of steel
Yes.
in India, it is not necessary that you go and buy a steel stock. That steel stock, obviously, I agree that if you buy a steel stock at the bottom of the cycle, that can generate, 10x return. But that 10x return or a 15x return can also come in a Linde India, which is more of a, sort of a oligopolistic market, if not monopolistic. Similarly, what we demonstrated to our clients in the past is that, if I'm bullish on the prospects of power as a sector, it is not necessary that I end up buying, a power generating company. Power can be also played through exchange which is known as IEX. So our view essentially is that, in the cyclical sector, it is better to play through a second derivative, not so obvious companies. So the same approach or a similar sort of approach, we are following it in renewables as a sector.
And which was the company that you mentioned, which is in the ancillary service provider space for renewables and has corrected 50% from its peak?
Actually, to be precise, Sangvi Mover is the company, but it has corrected, close to 65% from peak prices. And what we have also seen in
Okay.
some of these companies is that they will pivot their business models essentially, right? So what companies tend to do when there is a down cycle, for example, in this case of Sangvi, if you look at it, they are now focusing more on the crane rental business. Obviously, is in some pressure, uh, both on the yield side as well as the utilization side. That is the core business, but they are also now talking about getting into successfully. They have already forayed into wind EPC, which we find as an interesting play. And then obviously they are talking about a Middle East expansion over a period of time.
Okay, Sangvi Movers, ladies and gentlemen, had an all-time high of 742 somewhere in May of 2024, and it's at 240 rupees now. So in a span of 7 plus 2, 9 months, the stock has already corrected 67%, and there's a huge bar on 13th Feb. I won't trouble Aditya whether he bought on 13th of Feb or not, but this is what it is, ladies and gentlemen, when it comes to buying quality and buying quality in pain. So Sangvi Movers is one. Aditya, how about Frontline? You mentioned something about people being caught off guard in the large cap space where earnings growth is now reduced to single digits, and therefore you see this fairly strong correction coming into Frontline counters. Nifty is corrected 14%. What would be a good level for you to start, sort of rubbing your hands with glee when you look at large caps? What is that level of correction that you're hoping will happen in the market?
So our framework on Frontline is more focused on buying great companies when they have delivered 3, 5, or 10 years of zero return. Now this is a bit counterintuitive, so I'll just explain this further. Our belief is that every great business goes through 3, 5, 10 years of zero return, right? And this is very common. This happens to a Microsoft globally. It also happens to a Nike globally. It is happening to a Kotak Bank, HDFC Bank. It is happening to HDFC Life. So our view is that whenever the business goes through a down cycle, and if that down cycle is very prolonged, we would like to buy into companies when they are gaining market share in a down cycle. So that is absolutely very paramount, in the way we think about this is that we believe that if you can gain your market share when the market is not doing well, when the market does well or when the business recovers, obviously, you come out with flying colors. So our view is that, we'll focus on companies wherein, you see a very large price to value gap. Because if you logically think about, how you can make money in a great business, you can only make money in two ways by buying a great business. One is expansion of multiple. Second fact is that, earnings growth needs to be delivered. Now, in a country like India, broadly, most of the great companies will deliver that, earnings growth in the vicinity of 12 to 15%. But if we get the multiple right, or if we buy companies wherein there is very limited scope of PE multiple or price to book multiple contraction, that makes a very good recipe of stock picking. So today, for example, if I look at financials as a space, if I look at Axis Bank in particular, or if I look at HDFC Bank, we see some value opportunities emerging on the banking side. Bajaj Finserv is something that obviously I've highlighted. So we believe that these companies can do well going forward.
And you sort of neatly sidestep the value on the Nifty where you will be rubbing your hands with glee.
I think so broadly. See, the only thing here is that, rather than looking at the Nifty index, I would be watching very keenly on the, stocks which are bottom up based, because any which way is a PMS or AIF, the mandates that we manage, we are interested in buying high quality 25, 30 names essentially. So Nifty level, obviously, but the nature of the market also has changed in the sense that, today you will find a lot of people who are talking about a 20,000 level of Nifty also, right? Because people are saying that, this correction has got, this market can go down even further. Only one point there is that, if you look at last 12 months, essentially most of the indices have not delivered returns, right? And this is also coincided with earnings growth slowing down. So we believe that second half is going to be, materially better and materially different in terms of earnings growth momentum. I would say that Nifty can consolidate, but I would say that there could be a 15-20% probability wherein Nifty can go to that 20,000 sort of a level. But the broader market has absorbed most of this pain. In the sense that if I find 3,000 odd companies correcting by more than 40-50% from peak prices and are also reasonably priced. The other day I was looking at Twitter, and somebody flagged that there are at least 50, 60, 100 stocks which are trading closer to the COVID low also in terms of valuation or absolute price. So that makes a
Yeah,
very, very
correct.
interesting sort of space to look at or hunt for value opportunities essentially. And there were some there were some interesting companies. For example, if you look at MFI as a space today, you can buy a credit access Grameen, which is one of the best managed MFIs in this country, closer to the COVID low valuation, which was 2 times price to book. So if you look at, credit
Yes.
access Grameen, you will find that.
Yes. Yes, I think it's turned into a value hunters market, and this is the time where you need to convince your unit holders कि भाई जो फिक्स्ड डिपॉजिट में पैसे रखे हुए थे वो ज़रा दो, आप ही का फ़ायदा होगा इस लेवल पर खरीदने के. But my final question to you, Aditya, 2025, what will it turn out to be? A washout year, a year where value buyers such as you will put in some quality flags on how should I say degenerating landscape of earnings, or will it end in a hurrah? What do you think will happen?
See, it is very difficult to predict a year, but I would say that, incrementally what matters most on the domestic fund, earnings growth matters. That is, the story starts there, the story ends there. I think so. This 4 year of, wherein we got, excellent earnings growth is behind us. We are in an earnings reset environment. Incrementally, the US situation also matters, quite a lot from here on, because what we have seen happening in the US is, too much money has gone into those magnificent seven stocks, essentially, right? And now we are seeing a similar sort of phenomena happening in China, essentially, because Chinese market has, done well of late, and we have seen, the top 7, 8, 10 tech companies being bid for globally. So that is how the money pools are moving. Uh, I would keep a very, very close eye on mean reversion in FII flows, because at some point in time, once you have seen the currency outlook being more constructive as far as rupee dollar is concerned, and you see softening of interest rates globally, particularly in the US, I would like to believe that there has to be a mean reversion in flows. On the domestic front, one thing which is very, very critical from a systematic investment plan perspective also is that how does an investor think about 15% drawdown in the SIP in SIP? Because every mutual fund CEO that I speak to tells me that, a 10% till the time you don't get a 10% correction, there is no reason to worry about SIP inflows. And now we are seeing, a 15% drawdown in the SIP inflows, right? So that is what matters from a market flow perspective. As far as valuation are concerned, as far as bargain hunting is concerned, I think so we are just there in terms of, whether we can generate IRR, which is going to be market beating IRR for next 3 to 5 years, whether, you can construct a portfolio which is focused on, let's say, 2030, and whether you can buy companies for next 3 to 5 years. I think so we are fairly confident today that if you allocate capital and if the portfolio approach is right, possibly, the money that is deployed in today's market will generate, a very, very healthy IRR in times to come.
Right, Aditya, with that very helpful and positive and bullish note, let's call it a day on this show. Thank you so much for being with us, and of course talking at length not only about your portfolio but also your investing style. It's been a pleasure. Let's hope that 2025 turns out to be far better than what the first 2 months have come up with. Have a nice day and a nice evening. Thank you so much.
Thank you so much. Thanks for having me on the show.
Okay. That, ladies and gentlemen, was Aditya Sood, the fund manager at InCred Asset Management, a quality stock picker whose portfolio reflects the domestic growth segments of pharma, of hospital chains, and of course a bit of NBFCs and a bit of consumers. Let's hope that things turn out well for him and that the stocks that he picks up in 2025 make a supernormal return. Thank you for watching. I hope it was as interesting for you as it was for me to learn how to pick up stocks in this kind of a market. Have a nice day, but stay glued to Business Day Television. There's a lot that's happening on the other side of the break. Good morning, ladies and gentlemen. Welcome to our new show, Top Funds. This is where we focus on superb quality equity diversified schemes for various reasons. It could be a massive